All right, welcome back everyone to Wook Capital Management's 26th rendition of our weekly Wook and Review broadcast. Before I get things started, I'm Rod Alsman. I'm the Managing Director at Wook Capital Management. I want everyone listening to be aware that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss, unless it's the last day of the quarter and you're slamming calls on the QQQs, of course. I jest. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. All right, with that mouthful out of the way, what a thundering end to the first quarter, a very active first quarter, a wonderful first quarter, I'm sure, for some, depending on how you had your portfolio allocated. The Nasdaq is back in a bull market by the definition of it. It's now above the bottom by more than 20%. The year-to-date performance, in fact, is now at 20, as of the close, at 20.5%. The Nasdaq was up in the first quarter. At this rate, it'll end the year up 84%. Well, the best year ever. Something tells me it won't continue at that rate, but who knows in this world we live in. We're going to talk on some of the individual names today that we have on our Wookie watch list and how the some changes and news items in the market impact them. In the newsletter itself, I didn't put too much detail on kind of the current macroeconomic landscape, but I'm certain we'll get to that and folks can chime in on what they're seeing and observing in the data streams that they monitor most. So yeah, look, the VIX, the volatility index closed under 19 today. All the major indices were up meaningfully over 1.2%. The Dow Jones, the lowest, the winner, the smallest winner, whatever you want to call it. The Dow is just back to break even. The Dow is now up 33 basis points year to date. So it's a massive spread between value and growth. It's the widest spread since the dot-com bubble. Whether this is a new paradigm, a new bull market for real, or just repositioning and passive flows and people trying to mark up their investment books by quarter end, who knows the answer? I certainly don't. Maybe it's a little bit of all of those things. I'm happy again to kind of discuss and hear people's puts and takes, but really hard not to kind of think of it as a little bit euphoric when in the last 3 weeks the Nasdaq has run up 12%. But I'll get to that. So I mentioned in the newsletter, again, if you want to follow along with visuals, if you're in the Wook Discord or if you're a member of it, you can join the voice chat and you can see the screen share and any of the visuals I'm sharing there. I'll try to just kind of mention stuff, and it's mostly things that I think Joe is going to have posted in the nest that you can also kind of view on your own screen if that doesn't work for you. So just to kind of recap what we did from a programming perspective, we did host our 5th book club on Tuesday. So it was a nice refresher on a really, I don't want to say basic, but a really back to basics read, Joel Greenblatt's The Little Book That Still Beats the Market. So Greenblatt's magic formula, which is really just distilling down 2 inputs to derive a list of companies that he espouses to basically follow his formula without giving it too much more thought. But in a nutshell, the magic formula is ranking companies by their return on capital, their return on tangible capital, what is their actual quality. All else equal, a business with a higher return on tangible capital is higher quality than one with a lower return. So a company that doesn't require much incremental capital to generate incremental profit is better than one that requires a lot of incremental capital to generate incremental profit. And then the other side of the coin is the earnings yield of that security. And all else equal, a company with a higher earnings yield, a company that you're buying more current cash flow using the operating income, the EBIT, the earnings before interest and taxes, as kind of the proxy for the operating business, and then the enterprise value, so that you take into consideration both the company's equity and debt, as the other metric. So it was a good talk. I think the call went for a little over an hour. Probably would have been better that we did the little book that still beats the market before we did something as dense as Margin of Safety. But hopefully, for those of you who've been following along or who've read these and could have used a refresher, it was a good one. So we do have the balance of year book list. Joe, if you could maybe tweet that out and pin it. I know the graphic we were making like a last second adjustment to, but while I'm speaking, if you could do that, I'm going to verbalize the names of the books though in the interim. We have a plan to continue doing the book club on the last Tuesday of every month. We've got at the end of the year Thanksgiving and Christmas, of course. So for November and December, my plan as of now, it's March 31st. Things could change, but my plan for now is to keep doing the last Tuesday of every month for the book club. And then in the first week of December, before everybody goes on holiday vacations and whatnot, we'll cover our last book of the year. So I'll read off kind of the balance then of year books that we have, which again, Joe, I think is going to modify that image and get it pinned. It looks good to me. Joe, I see what you shared. So we're going to do The Big Short next, first off. If you've only watched the movie, like me, fun fact, I first watched The Big Short it was January 24th, 2021. So the Sunday before Meme Mania week got underway was the first time I ever watched The Big Short. So fittingly, that was fun. So I'll be reading the book for the first time. We encourage you to, whether you opt to read the book or just watch the movie, I think it's a good time for us to come back to that and think about, even though this landscape and banking crisis is not, of course, one for one with that, I think it's very timely for us to kind of go back and talk about what led to the failings in the GFC, and obviously the traders who position themselves accordingly, like Michael Burry and many others made famous by the book and the movie. So looking forward to doing that one on the last Tuesday in April at 8 p.m. One Up on Wall Street by Peter Lynch will be our May book. Think Twice by Michael Mauboussin will be June. Mastering the Market Cycle by Howard Marks for July. Fooled by Randomness by Nassim Taleb will be August. The Warren Buffett Way by Robert Hagstrom will be September. The Little Book That Builds Wealth, not to be confused with the one we just went over by Greenblatt, is by Pat Dorsey, and we'll do that in October. And then the last book of the year is one that's not out yet. We've had the pleasure of working with the author over the past few years, Nathaniel Popper. Joe, you've spoken with Nathaniel more than I. Maybe tease that book for a minute.
Yeah, I mean, he's hoping it's going to be out in the summer. So if it does come out this summer, maybe we move that one up in the schedule a bit, because it would be really nice to have him participate in the discussion on the book, and I'm sure it's something I could ask of him, considering we've worked together on it for quite some time now. So I'm really excited for that one. It's going to be good. No one knows the GameStop story better than Nathaniel, so I'm very excited to see what he puts out.
And I know he wrote some other books, and it's skirting my mind right now, but he's written other novels that have been big hits, right?
Yeah.
Like on crypto, I forget what it's called. I could Google it, but I don't feel like it.
Digital Gold, yeah.
Digital Gold, okay. So yeah, he's a good writer. I've had a few conversations with him over the last year or two. Joe, I know you have as well. Look forward to seeing what he puts out. And like you said, we'll kind of slot that in the month in which it actually is finally released, so that it's a little timely. And I'm sure he's a verified member of the GME Discord, so I'm certain he'll be willing to participate in a conversation with us for that book club session, I hope. So that's what's up with the book club. Joe's got it pinned. if you missed the recap that I just verbalized, and we'll look forward to talking about really all of them as they come. And really, The Big Short, I'm actually very excited to read the book, having only seen the movie. So should be a good discussion, very timely. All right, with all that said, then, just other programming notes. Bear in mind, we continue our Wednesday open mic series that Joe and I host on my personal handle at Rod Alsman. This Wednesday was a pretty solid one. Actually, Joe, maybe you could pin that one to the thread here as well. We had a whole slew of discussions that spanned portfolio construction, and how one thinks about position sizing, how one screens for investments. We talked about a variety of different sectors, running the gamut from nicotine to life sciences to industrials to financials. It was really all over the place. So it was about 2 hours. We did that Wednesday night. We do them every Wednesday night at 7, and just trying to share information and make everybody hopefully a little bit more knowledgeable and aware of what's going on in the world and different investment ideas out there. So, of course, then we will continue having our Wook Reviews Friday at 4. We do have, as I mentioned, we're going to touch on some of these Wookie watch list stocks, which do skew toward kind of retail favorites based on feedback from our audience. So we're going to touch on each of those stories for a few minutes. I'll welcome anyone in the audience who wants to share any questions or comments on that particular story before we move on to the next one. And then once we get through all the prepared discussion material, of course, I'll kind of open it up if anyone wants to talk about any other items this week that we didn't get to touch on. It was definitely a little less crazy out there in the world, it felt, but a lot did happen. So, all right, with that all said, then let me get into it. First off, Lucid Motors is one that we put on the list. We opted not to put Tesla on, or we do have Tesla on, excuse me. We also opted to put Lucid on, right? The electric vehicle shift is very interesting. I think Lucid is a prospective contender, although the unfortunate reality is that it takes a lot of investment to scale up these businesses and to get to the scale necessary to cover your fixed cost and your variable cost and get to operating profit and hopefully beyond. So in Lucid's case, Lucid Motor did come public through a de-SPAC in 2021. So the company did have a memo out this week where they'll be cutting about 18% of the workforce. A little less than 1 in 5 of their 7,200 employees will be let go. And it's just a very challenging environment for a lot of these startups. And I was listening to a broadcast on FreightWaves yesterday with an analyst from Gartner. If you're familiar with the Magic Quadrants or the hype cycle, Gartner is well known for those things. And the analyst in question I actually worked with a few times while I was at Ryder on electrification and autonomy. So I think he's a solid analyst. But kind of what he said that I think really rings true is, the companies that have the necessary balance sheets and kind of runways to survive are really going to be the ones that's going to be as important as anything else, as just as important as the partnerships that they have and the customers that they've secured and the products that they've put together. If they can't survive, they're going to be purchased at a depressed price by somebody else in all likelihood. So this isn't a comment on Lucid, but just kind of generally speaking, I think that's the sentiment that a lot of those monitoring the startup space feel right now. And yeah, Lucid is going to have these major layoffs. The company is going to be looking to have cost discipline and optimize their cost structure so they can achieve their objectives, and that it was, quote, a painful but necessary decision. So that rumor came out on Monday. The company put an SEC filing out on Tuesday. And it's just, again, a continuation of these layoffs hitting the tech and startup space. Lucid in particular has been challenged as they try to scale production. I included a link for Brad Munchin, who goes by Motorhead on Twitter. He had posted a Substack story of his, kind of speaking about it from his analysis, of view that the company will need to raise $5 billion in equity this year to stay afloat. I know that the Saudis have a meaningful ownership stake in Lucid. I've, from my understanding, come to appreciate that they do have some impressive electric motor technology that they've developed, and it's not like they are vaporware. It's simply a matter of the costs associated with getting these businesses to production and getting to scale and getting to profit, which none of them have really achieved yet, other than Tesla, to their credit. So that's kind of where Lucid is at. I'm not an in-depth expert on Lucid, but thought it was worth noting. We do have it on our watch list. If anyone in the audience is well versed in Lucid or wants to share any other information that relates to what's going on there, would love to hear it. A few other kind of points while I pause after to see if anyone's raised their hand to come up and speak on it. They had their EVs don't qualify for the new EV purchase credit because of the dollar amount. It's a premium priced vehicle, a luxury vehicle. The threshold, I think it's like 80,000, or I don't know the ins and outs of the cutoffs now. I know that Treasury just came out today with some more information on what will and won't be eligible, which it seems like it's still a work in progress. But look, we've talked about this in other Wookin reviews and venues, that there's just oodles, hundreds of billions of dollars, if not pushing into the trillions of government largesse flowing into the sector. It's really impossible to ignore how much is just being thrown at manufacturing incentives, nearshoring, reshoring, locating manufacturing in allied or trade partners of the United States from the Inflation Reduction Act. So that doesn't go away, right? Unless the current party out of power is able to somehow get a massive, majority. I find it unlikely that the Inflation Reduction Act goes away. So that is enshrined in law and is going to exist. And there is going to simply be a lot of capital flowing into the space for a decade or more to come. So it's definitely one of those spaces I understand why people want to invest in, but I think a Lucid story is just another good example. It doesn't matter how good your product is. You could have the absolute best electric motors and the best designers and the best of everything. But if you don't have the ability to go from subscale to ramping production to getting to scale, surviving the cash burn, et cetera, then it doesn't matter. And I think it will continue to be a space where a lot of capital is destroyed in the pursuit of all of the opportunity, which it is a very large growth opportunity. So I just warn investors to be cautious of that and cognizant of that. So that's my rant on Lucid. Joe or anyone else have any thoughts on Lucid?
Oh, I will just add, I mean, living here in Southern California, I do see a few Lucid cars on the road. I mean, it is rare, maybe one or two a week, but I do see a hell of a lot more Rivians. I see the Amazon Rivian vans, and I see the trucks all the time. Like probably see as many trucks as I see Model S's, and it's kind of crazy. So Lucid though, it's still tough spotting them out and about. I think maybe, like I said, one or two a week max.
Never seen one in person here in Florida. I saw my first Rivian SUV yesterday, actually. A neighbor a few houses down has a Rivian truck, so I've certainly seen more of those than Lucids as well in my backyard. Okay, well, if people want to talk more about Lucid at the end, we can circle back to it. I'll keep going then through the prepared material. Next up is Lyft. So we put Lyft on as opposed to Uber. Thought it would be more interesting, I think, to kind of follow the smaller player. And Lyft has been ceding market share now for some time. It's largely a duopoly in most markets. As for those of you who are unaware, Lyft operates solely in North America. They do not have a global presence like Uber does. And in most North American markets, outside the really mega cities, your option as a consumer is either a traditional taxi cab or comparable, Uber or Lyft. And Lyft this week had its co-founders, co-CEOs step down. Board member David Risher succeeded the two and is now CEO. They are remaining on the board. He had an interview I saw earlier this week, which I'm just playing on my screen with the audio off, with Ed Ludlow at Bloomberg. Denied that the company is for sale. It's kind of in line, I guess, with the discussion on Lucid. To me, it beggars the question, and I don't know the cost structure of Lyft in and out. So again, I'll welcome discussion from anyone in the audience who may know it better than me. But it also seems to me like one of those businesses where I know the rideshare space a bit from a unit economic perspective, unit economics perspective. That space has just always kind of been chasing the magic bullet of AI, AV, not AI, AV, autonomous vehicles. To take that labor component out of the equation, which it's just really tough. I've seen a lot of bull cases from Uber bulls over the years. I remember when I was going back to grad school pursuing my MBA, and this is 2016, 2017, and the mega Uber bulls of the world kind of saying, oh, they just need AV, and then once they get there, it's going to be, yada yada, this incredibly profitable, incredibly powerful network effects. And fast forward 5 years, 6 years, and AV is still nowhere to be seen. Both Lyft and Uber have really shied away from autonomous vehicle investment, which they both made significant investments into over the years. It's we talked about AV as it pertains to Tesla's autopilot, right? Autopilot is a level 2 advanced driver assist system. Elon's been shilling his purported level 4 system for many years. That's not here and may never be here. A level 2 system is the car is making you a better driver, and that's all well and good. But a level 4 system is what you need to really get the driver out of the vehicle. And the rideshare services have not gotten to that point yet. Even on the truck side, not to go too far away from Lyft, but players like Too Simple have not gotten truly operationalized yet. Players like Embark, which I don't know if they failed yet. I had seen that they were in deep trouble. Kind of going back to the whole idea of if these companies are undercapitalized, they're SOL. So it looks like the stock is still trading. It was up 8% today because why not? But I had seen earlier this month that company is basically done, and they're shutting down. They're laying off their workers. They ran out of capital to fund continued deployment. That's the story out of Automotive News from March 3rd. So that's a company that when I worked at Ryder had partnerships with. The idea was that you would have a local driver handle the more complex portion from bringing the truck from the dock to, say, an off-highway hub, and then the autonomous truck would drive itself, say, from Interstate 10 in Southern California or Phoenix or Arizona to Dallas or to Texas or whatever, handle that long stretch of open roadway where you don't have to worry about pedestrians, you don't have to worry about more complex interchanges, etc. And that was their model, and they ran out of runway. So going back to Lyft, Lyft's been hemorrhaging market share. They're down to a little bit more than a quarter of the market they play in. The stock price has obviously done quite poorly from last spring. It was trading near 40, and let's see, I'm sure it traded up today because everything seems to have, except for my tobacco companies. But Lyft was up 2%, closed at 927 today, so still 3.5 billion market cap. If we look at the kind of estimates from analysts, it is on a forward basis profitable from the sell side research. It's not cheap by any stretch, right? But when something's at like that kind of inflection point between profitability, if they can start to regain some of that market share, they may be in good graces. Just as a consumer, I use both apps. Kind of, I'll open my phone, I'll check both, check which has the best price, and by and large, that'll drive my decision making. There's a couple quirks here and there where, if you have the right credit card benefits, maybe Lyft or Uber make more sense. They might give you some discounts, but I don't see that they actually have any compelling competitive advantage other than if you're the last man standing, then maybe you're able to then consolidate share, take price up, and begin charging like a monopolist. So I'm sure Uber would love it if Lyft were to fall off the face of the earth. I'm not sure that's going to happen. It doesn't look like it's that urgent yet. But new CEO. They say they're not for sale. They're still ceding share. Not sure if anyone in the audience has any thoughts they want to add on Lyft. Joe, if you want to share any thoughts on Lyft.
I mean, it's more of a bet on ride sharing than Uber is. Uber has so many different facets now. So if you're just purely looking to invest in future of ride sharing, I think Lyft is more focused, but not looking too hot.
Yeah, that's right, and we'll see how well kind of consumer discretionary demand holds up. And we've obviously talked about the idea that there's some headwinds coming in a few months here with student loan repayments getting turned back on. Will younger consumers be going out to party a little bit less frequently? How much this kind of surge in revenge spending on travel and services reel back toward normal as the year keeps rolling along? So some real headwinds, I think, for Lyft, but big shakeup, and I'll be interested to keep monitoring what happens, and we'll keep reporting on it. All right, got I think three more little topics to kind of share some thoughts on. Again, if anybody wants to speak, you're welcome to. Don't hesitate, unless you want to continue to listen to the dulcet tones of me rambling on. So this one's Alibaba, right? So we have Tencent in the watch list, and while the news doesn't directly pertain to Tencent, it will indirectly probably impact their future decision-making process. So earlier this week, a major news out of China that Alibaba is going to basically allow each of its six, or not each of, but six of it's going to split its empire into 6 units, and it's going to let each of those 6 units pursue capital raises, whether through IPO or whatever. One of those, the logistics arm, already apparently is moving forward in Hong Kong toward a listing. So, shoot, we didn't include that graphic in there, but most of the business is the core Chinese commerce platform. Of the 200 whatever billion dollars, $220 billion in revenue, 160, 170 billion, sorry, that's in yuan, is the core commerce platform. And then after that, it ratchets down meaningfully, maybe 15% of the size of that core business. You've got the cloud business, similarly sized, the international commerce business, logistics business that I just mentioned, a little bit smaller, their local services business, and then their media entertainment businesses. So this is, I guess you could say, the culmination of this years-long crackdown that China had really kind of brought to bear on Alibaba. If you think back all the way to, I guess, what was it, early 2021, the Ant Financial was going to come, public potentially, an IPO, and that's no longer in the cards. But that kind of brought a stream of a crackdown from the Chinese. Just looking at the Alibaba stock chart, the stock had peaked in late 2020 at 310 per share or so, and while it had a nice rally this week on the back of the news that it's going to move ahead with this breakup, it was up almost 20% this week. The stock's still at $102, so we're still at a third of the peak valuation from a few years ago. Obviously, last fall it got down to just all-time lows. 60 got under $60 per share. Our chief investment officer fortuitously actually was able to get some significant buys of Alibaba below $60 that morning. We no longer have a position in Alibaba. We did sell after the significant rally, but I actually, just speaking purely personally, I think there's probably more upside to go for Alibaba. I think this is great to kind of unlock value, let investors, really pick where they want to focus their capital allocation on. Some of the parts is kind of a, not a great analytical model unless the parts are going to be spun off or IPO'd or allow for that value unlock to be realized. And I think here's a prime example of that. So, any of your sum of the parts Alibaba exercises, maybe that was silly to conduct in past years, but now that we know that they are moving ahead with this, I can't pronounce the name of the logistics business, Kainao, whatever it is, but is going to become, a separately traded business. It'll be interesting to see how much ownership the core kind of enterprise retains, but lets investors really invest where they want to. And just to kind of quote from the article from the Evercore analysts that cover Alibaba, quote, "For Beijing, it addresses the concern over the abuse of monopolistic power by internet behemoths. The split up could also serve as a template for Alibaba's peers, but we don't expect any imminent similar move." So that's why we included the story this week. Tencent may move ahead with also breaking up its empire in some capacity. Those analysts don't expect that imminently, but Tencent also saw a rally. Again, if you kind of see the Bloomberg story, I'm opened up on, you can see that both Tencent and JD rallied this week on news, not as significantly as Baba, but yeah. So that's what's going on in China with Alibaba. It'll be interesting to see, if any of that kind of comes back stateside, and do we see any of the mega cap tech companies willingly break themselves up to unlock value? I don't know the answer to any of those things, but again, welcome any perspective from folks that are tuning in. Chris R., I brought you up, and again, anybody else, if you want us to come up and speak, just request and we'll happily bring you up. What's up,
Yeah,
man?
it's interesting. Last fall, I think, or last year, JD had spun off its logistics business. You know JD, Jingdong? The ticker is JD. They're a kind of a competitor. They're more like Amazon. They're like an e-commerce company, but they had a logistics division that they spun off last year in Hong Kong called JD Logistics, and they IPO'd that. Also, Tencent had a very large stake in online services like food delivery, kind of like Uber. It's called it's like the Uber of China. It's called Meituan Dianping, and also trades in Hong Kong. But they had a stake in it, and they gave that off as a dividend. So Tencent basically divested it through their shareholders. So anybody who held Tencent shares last year, which I did, got, I think, 1 share of Meituan for 100 shares of Tencent, or 10 shares of Tencent, I think. Yeah.
I'm looking at a story from 19 hours ago from Reuters that noted JD also spinning off its industrial and property units, which both of them are north of $1 billion, and those are being listed on the Hong Kong exchange. So yeah, this is all happening pretty quickly.
Yeah, it's been happening for some time, just in the last year or so. But yeah, I mean, I think this is good news for Alibaba. I mean, if you want to invest in something, you can choose exactly what you want to invest in. I think there was news that they would do a primary listing in Hong Kong as well. Maybe this is just related to that. People were worried that you can't own the real shares, right? Because it's a VIE and there's a VIE structure, and but if you can own it on the Hong Kong exchange and own the primary listing, maybe that's appealing to some people who worry about that stuff. But not many people trade on the Hong Kong exchange compared to New York, but I think it's still, a big deal as they are spinning off these businesses. But yeah.
Yeah, for sure. I'll be first to admit I do not know the Chinese market at all, so I can't speak knowledgeably on the ins and outs, and which if any of these have competitive advantages over others. So more so, we are just trying to flag the information at minimum. So I don't want anyone to walk away thinking I'm saying that Alibaba is better than JD or Tencent or whatever. I plead ignorance. But
yeah.
Hey,
have you heard of AliExpress?
Heard of it?
Yeah, it's kind of like these new apps like AliExpress. There's Temu. These apps, and Shein is another one too, where you can buy directly from China, and there's like really cheap stuff. They take advantage of these, importing packages. Like if this is like a low value package, right, you don't pay any tax on it basically, and the shipping is like dirt cheap. So like Alibaba, this Cainiao business that they own, it's this logistics business. They use that for the majority of packages, and it's really sophisticated stuff. It's kind of like Amazon, but on they do it even faster. It's kind of crazy, and they want to ship.
Isn't it all basically contingent on these kind of aged international like mailing rules where the Chinese are basically able to like dump goods like way below what like would be like a fair, I guess.
I think that's a big.
I mean, maybe that's a little bit of bias.
Yeah, that's definitely a risk. There are companies like Wish. They were at risk of this, and I think EU started to tax this stuff. So like companies that didn't have a competitive advantage, like Wish, they got wrecked last year.
Yeah,
really bad. But yeah, so I think also, I don't know about the antitrust situation in China, but maybe this is also an antitrust thing. They want to like break up these companies so that Tencent doesn't own everything, right? They don't want Alibaba to own everything. Maybe that's another angle. I haven't really explored it much, but I think that's an interesting thing to think about.
Yeah, I think it makes sense. And again, not knowing the ins and outs of Chinese politics beyond what I read and try to consume from various sources, is that the state doesn't want, I mean, the state wants to be a leader in a lot of these cutting edge spaces, but it also doesn't necessarily want just one or two gargantuan firms to control everything. Like I saw just recently, I thought some negative comments from Xi around CATL, which is of course the largest battery cell manufacturer in the world and has grown phenomenally in recent years. But I thought I saw some kind of, I don't know if they were like concerning. I'd need to pull it up, but regardless, I think that's in line with what the CCP wants, is not to have so many massive quasi-private businesses that run everything. But again, I don't know, and would welcome anyone who's an expert or more knowledgeable to chime in. But Chris, I don't know if that aligns with what you understand or if you'd push back on it.
Yeah, I follow a couple of guys on Twitter. I think there's Sino, Auto Insights. They're very good. They're pretty level-headed, and they talk about a lot of the Chinese EV industry, which I think doesn't really get much coverage in the American media. And it's an English language, sort of, Twitter accounts, and they have a newsletter as well, and they do a weekly spaces too, I think. But yeah, I think with CATL, they have a very good relationship with the government. They've gotten a lot of government money. They've gotten billions in subsidies for the last decade as they've been developing this LFP supply chain and technology. And of course, when the government pours money into this, they want to have, some sort of say, right, in terms of, how these companies, expand their influence. Right? It's like this money is not free, it's to develop the economy.
Right.
And but yeah, it's like as an investor, you're like, hey, like, do I actually own this thing? Do I get to decide? And like what?
It's just incredible. CATL growth in 2022 was nearly 100%. I'm looking at, I think this is a Korean source. So I don't know, precisely how they did the sizing of the market shares, but they're showing CATL market share at 37%. This is global market
Yeah.
share. You can add together LG Energy, SK on Samsung SDI, Panasonic, and still you could basically add together the next 4 or 5 players, and then combined they add up to CATL. Like, it's a massive lead that they have over these other players who were the incumbents, right?
Yeah.
When CATL was just the nascent startup, Panasonic, LG Energy, Samsung, like those were the players, and now they've just been absolutely surpassed.
Yeah, and BYD had that profit
BYD is
growth.
third. Yeah. And BYD is now on par with LG Energy, right?
Pretty crazy.
LG Energy grew 18%, BYD grew 167%. So BYD is going to leave them in the dust in short order.
Yeah.
And you know who isn't listed there?
No. Tesla?
You know what company is not actually a battery cell manufacturer?
They assemble the
Leave it at
cells.
that.
They do assembly of the cells,
Yep.
which is good too. There's different parts of the value chain for sure. And CATL, they only do the cells and then some pack design. I think they let the other companies make cars and stuff.
Yeah, I know that was one thing that during my time, kind of when I was all over following what the OEMs were doing from an electrification strategy perspective during my time at Ryder, that was the thing. Like, Daimler would partner with CATL. CATL would source the cells, but Daimler would impute its own know-how into module construction and how they're going to arrange that into a pack. And CATL was really kind of the just the cell side of things rather than kind of the module, the pack, and further down the system. But that was my experience, like with the truck side, was that typically the suppliers, the cell suppliers, that's what they are, is they supply the cells, and then the OEMs, want to have some level of expertise or advantage in module and in the pack itself broadly.
It's funny because I actually can't invest in CATL. It's on this one exchange. It's kind of like the Nasdaq of China, I think, and only institutions can invest in it. And like, there's just one. I don't know if you follow Taylor Ogan on Twitter, but he runs a fund called Snowball Capital. But he moved his fund to Shenzhen partly because he wants to invest in this company. But yeah,
it's going to be very interesting to see how this all plays out in the coming years. I don't know if you were in the room when I was talking about the Inflation Reduction Act and how much capital is just being thrown into the industry domestically and in partner nations, and how this pans out in the war, the digital war between the U.S. and China for leadership in the space, which obviously China has a massive lead across the entire value stream, and the U.S. is looking to chip away at that. But yeah, it's going to be interesting to keep monitoring in the coming years.
Yeah, it seems like a lot of the like Korean and American and European companies are banking on solid state batteries, right? If those pan out, it would basically make.
I think that's a when, frankly.
Yeah.
But that when uncertainty is obviously quite large, and with some of the deadlines that the different regions are looking to get away from internal combustion by, it obviously is still unknown if even before the end of this decade we're going to see a production solid state battery in any sort of scale. And I don't know the answer to that. I haven't been obsessed with that industry in several years now, but you get these announcements about revolutionary battery technology every other day, and many years then go by, and then that company is gone and it was just a sham or whatever. So I try to be level-headed and I trust that when Toyota, says that that's kind of what they're waiting for from a mass production perspective. Like, I understand their logic. Obviously, some are bearish on Toyota and think Toyota's being left behind. I'm inclined to believe that in the long run, actually, they know what they're doing, and they're being very strategic with it. But clearly, the wave of adoption we've seen in the past couple of years is faster than they and the Korean OEs, I think thought would happen, and the American OEs, ex Tesla too, the German OEs. So it's definitely happening. This electrification of transport, but yeah, it's gonna be still be very messy and long and drawn out process to march up this S curve. But okay, then let's move on to. They weren't in the newsletter. One note was being goofy in my note taking. For whatever reason, Joe's side didn't see the other notes I had. But I've got two more items then before we kind of just open it up to whatever folks want to talk about. So one, I think it would be silly to ignore. We have Ethereum on the watch list. So while the lawsuits weren't directly targeting Ethereum per se, there was obviously a lot of news this week from the Commodities Futures Trading Commission, the CFTC, alleging that Binance is running an unregistered, offshore exchange, letting U.S. customers sneak on and use VPNs. There was some, interesting messaging between Binance internally that you just kind of face palm. It's like, are you guys really putting this in writing? But this is just a continuation of an uptick in regulatory enforcement across the entire crypto space that on the back of all of these Ponzi's and frauds that have imploded over the past year or so, you've seen a big increase in enforcement. The SEC, the CFTC, Gary Gensler, the chair of the SEC, has made comments really that he sees the vast majority of the space as unregistered securities, calling stable coins the chips at the poker chip in the casino, so to speak. So the story that I didn't include, but it was in Bloomberg earlier this week, had some data points. For example, the SEC doubled its crypto assets and cyber unit last year. They clearly are moving forward. There was a Wells notice preceding a potential enforcement action relating to Coinbase operating an unregistered securities exchange. Prospectively, we'll see what comes out of that one. That one hasn't really yet, hit the fan yet. The SEC notified them that they're threatening action, and we'll see what that action ends up being and if they end up succeeding. Clearly, there will be litigation. But the Binance part came from the CFTC and really kind of highlighting the inappropriate allowance of Americans to access their systems. So there's a lot of quotes in the story. Quote, I think this case, speaking to the Coinbase case, has the potential to be the most consequential in the history of crypto. One of the outcomes of the Coinbase case is we will likely get some actual legal clarity. So some in the industry are counting on it to go all the way to the Supreme Court. I think that's reasonable. It probably will. That will be interesting to see with the right-leaning Supreme Court, whether it decides to say these things are allowed. Obviously, there are securities laws, and there's a lot of uncertainty around what is and isn't. So hopefully we'll get some clarity across whether you're pro, con, or neutral around what is and isn't allowed. But regardless, the whole suit against Binance, definitely read into some of the details there. It looks like the shit is hitting the fan for the crypto space, right? We've got Mr. Bankman-Fried. It seems like racking up more and more crimes by the day. Mr. CZ, the CEO of Binance, maybe he's going to be next, and who knows what happens then with Coinbase. But a lot of regulatory enforcement is finally coming down on the industry, and you get the ardent proponents of it, that I think sometimes miss the fact of how many people are harmed and have been harmed and continue to be harmed by the sector and the lack of oversight and the like. That saying, that the U.S. is trying to stop the sector, and I guess we'll see where it all pans out. But it also was beyond just centralized institutions like Binance and Coinbase. The story notes that on March 21st, what a wonderful day, the Sushi Exchange disclosed that it had received an SEC subpoena, and that's a decentralized exchange or protocol. So it's not just the centralized protocols that the SEC and the regulators are kind of coming down on. It's definitely heating up. There's a lot more to come on it, but the Binance news this week was a hot item, and whether Ethereum or Bitcoin end up being more than just commodities, and whether Ethereum's a security, who knows? But we'll stay tuned. I don't know if anyone is that interested or that knowledgeable in space and wants to add any context to some of that. Obviously, the banks, a couple of the banks that failed, Silvergate and Signature, were crypto friendly, and how much of their failure had to do with that, I don't know in the weeds why, the answer to that. But again, it's just a continuation of this general theme of continued enforcement is coming. It's here. It's happening, and now we're going to go through litigation, it looks like. And okay, so seeing no one else come up then on crypto, I'll move on to the last one, which Chris, hopefully this will be close to the last time we talk about Bed Bath, but we've got to cover it. It's like a zombie that just won't die. Bed Bath and Beyond yesterday ended their deal with Hudson Bay Capital, which if you've tuned into these, you've probably heard too many times. Now they have filed an at-the-market offering to try to raise $300 million through share sales to avoid a bankruptcy filing. In yesterday's filing, they basically said, if we don't raise this, we will be filing bankruptcy. So in the next month, they are going to try to sell up to $300 million of common stock on the open market. If you don't get money stuff from Matt Levin, you're missing out. He wrote up about it yesterday afternoon, and he's been on top of it really since day one. Since anytime quirky stuff happens in the financial industry, Matt usually writes about it, and he's written about Bed Bath extensively. But he kind of goes through the whole story. But where do we stand now? You had this deal where Bed Bath and Beyond approached, or sorry, not Bed Bath Beyond, Hudson Bay Capital approached Bed Bath and Beyond in the days preceding. They were going to file bankruptcy, is how I understand it. In my conversations with people familiar with the matter, they were going to file bankruptcy. Hudson Bay Capital basically took Jake Freeman's idea and kind of changed it up. His idea of allowing, his idea was that the company could effectively monetize the elevated volatility and allowed them to restructure their debt, but also kind of give creditors a reason to go along with it. It would have benefited equity creditors and the company. Of course, fast forward, the company didn't act on his recommendation. The operations continued deteriorating, the cash burden continued deteriorating. Then come, after the holiday season, where they had most of their shelves not stocked. In February, they were going to file bankruptcy. Hudson Bay Capital had came with their own version of Freeman's plan that allowed them to basically have this really convoluted scheme wherein they would get these preferred stock warrants, and then convertible preferred stock, and then common stock, and yada, yada, yada. The long of it was that the company now did raise, I believe it was $360-ish million from Hudson Bay Capital through that whole process. The shares outstanding, though, have absolutely ballooned. So that 360 million raised their shares out from 117 million when it started the Hudson Bay Capital deal. Now it has 428 million. So the share count has almost quadrupled. The company, sold those shares on net for about $1.16 per share. So they got the $360 million. And now, because of the price continuing to fall, Hudson Bay's out. you have this at the market offering where the company's going to be simply selling shares on the open market. And this news came out yesterday. The stock this week is down about 50%, on the back of this news. So in the last day or two, it's down, the bulk of that, which, it's unfortunate. Again, I keep saying this, and I know people don't like me. Some people don't like me, and that's okay. I'm quite content with being unliked, but I'm going to tell the truth. And the truth is, a lot of these people have really clung to the idea that there's some M&A action that's going on. And look, ever since the Hudson Bay deal, I've been ardent that no, the company was going to file bankruptcy. Instead, it chose a path that may be advantageous for employees, for creditors, and for the equity not going to zero overnight. But that existing equity is going to be diluted ad nauseum and into the ground, and that there's probably no value in the equity. Matt's story kind of lays out. Right? He basically says, look, could you file bankruptcy right away? You could, or you keep trying to raise money, and maybe eventually you do file bankruptcy, but you raise some money in the interim. I still think it's just a matter of time before the lights go out at Bed Bath & Beyond, unfortunately. I'm curious to see what happens out of bankruptcy. I do think that there's some assets that people may be interested in bankruptcy. Buy my baby, right? That operation does seem like it has value. But, unfortunately, I think people, a lot of retail investors that are not maybe as sophisticated and don't have years of experience see, a share price continuing to go down, and they assume that because the share price is low, that is an attractive investment opportunity. And I just cannot say enough that is not the case with this security. The dilution, as I noted, has been rank. Your one share at 43 cents is, worth a lot less in the context of that denominator just keeps getting larger and larger, and the company is selling more and more shares. And it goes back to what I keep saying: just because you like a business, you want it to succeed, that means absolutely nothing in the context of it. It's an attractive investment from getting a risk-adjusted rate of return on your capital, on your hard-earned money. So it's unfortunate that a lot of folks, I've seen a lot of loss porn, right? The people who bought into it and maybe kept buying just because it kept going down. Diamond handing makes sense if you have a thesis that's intact and is real and has not been broken. But in this case, unfortunately, I think it's just steps away now from the final filing, whether it's Chapter 11 or Chapter 7. Chris, I don't know. You've obviously followed it closely. I don't know if you push back on any of that, or if you think they could pull something out of their hat, or where you think this goes next. I haven't actually pulled up the stock, not the stock. I haven't pulled up the bonds in a couple days. But what do you think?
Look, I'm not going to write anything out, right? I'm not going to write anything off. A lot of people thought they were going to file in January. I thought they were going to file, and they didn't.
The market thought they were going to file.
The bond market definitely thought they were going to file. Now I'm looking at the bonds. I'm seeing, those 20.
Yeah, I see
notes.
3 3/4 cents on the 24 bonds, under 5 cents on the 34 bonds, and a little over 5 cents.
No, I'm seeing
on the dollar.
7 cents on the long dated, the 2034 and 2044 bonds.
I'm sorry, I'm looking at the coupon column. Yeah. I'm an idiot. You're right.
And then about 11 to 13 cents on the 2024s. Those take a really big hit because those are very near to mature. Very near to maturity.
Yes, I see that. So that was kind of the thing, though. If you go look at year to date, or even just look at 1 year. If you're following along on the screen, you can see. Yeah. If you're watching the replay, you can see. But the 2024 unsecured debt, which again, remember, you've got secured creditors will be paid first when there is a liquidation or a bankruptcy. And there's going to be the secured creditors, and then you go to the unsecured creditors, and then last but not least, if there's any scraps left, equity. And in this case, the unsecured debt is trading at pennies on the dollar, 11 cents for the 2024s. So the market does not think that unsecured debt is likely to get a recovery of really much of anything. So that is not a good look for equity.
Yeah, I think the undersecured paper is definitely out of the money. These bonds, they don't really have any hard assets that you can take out of a bankruptcy. But I guess the hope is really that maybe they raise some more money, right? That debt becomes less out of the money. Like that was a great trade back in February, right?
Yeah, if you got the 2024 debt, even the day before, I think it was, or the day before the deal with Hudson Bay Capital was made, because the equity went crazy and the bonds didn't move. And I made a comment like that this is deeply irrational. And then the next day we got the news of the Hudson Bay deal. So like you could have bought those bonds for 4 or 5 cents on the dollar in late January when it looked like they were going to file. The market thought they were going to file. They didn't. Those bonds rallied and basically went up, 6x. Right? You could have gotten a 600% return on buying bonds. That doesn't happen too often. In a week or so's time. Again, it's all about when you bought and when you sold in this case, though, because if you didn't sell, they're now back to 11 cents.
Yeah. So I think if you're playing bankruptcy, you really don't want to own those 2024 notes because you're just paying more for the same claim. They're all have the same lien on the debt, on the company assets. But yeah, I think it's still interesting, right, to see how cheap can this go, right? And, how many cents is this debt worth? Can you get equity out of a bankruptcy, right? After a Chapter 11, after a reorg, will the business actually survive?
Because the secured creditors have a claim on Bye Bye Baby, right? When they did the Philo loan,
they have a claim on all the cash assets, right? So any short-term investments or cash, inventory, things like this. I think the Philo has a claim on Bye Bye Baby. I'm not sure exactly what the extent of that is. But yeah, it'll be interesting. And, of course, when things get to a Chapter 11, right, you're going to have two creditors committees, right? You're going to have the secured creditors and the unsecured creditors. And they're going to have to duke it out and come to an agreement quickly, or else the lawyers win.
Yeah, you wouldn't want a liquidation of the Bye Bye Baby business.
Yeah.
I don't see why that would be the final outcome. You might have a liquidation of the Bed Bath Beyond business, and then maybe they find an interested buyer who does, pay a price that the creditors can agree to out of bankruptcy. Right? Who knows? It's not going to go away. It won't be over. That I think that business, it makes sense that it'll survive. Equity won't survive, unfortunately. If you're buying these shares at 40 whatever cents because you think it's cheap, again, the denominator is going up. The company just told you yesterday that they're going to try to sell as many shares as they can to stave off bankruptcy at ever decreasing prices and at ever decreasing valuations. So the creditors love this, right? Because every dollar that that is sold, every all of these millions, right? The 360 million, that Hudson Bay Capital's agreement raised for the company, went obviously toward buying inventory and trying to operate the business. But when and if they liquidate or whatever they end up doing, that's good. That 360 million is 360 million that wasn't there for the secured and unsecured creditors. Although, like you said, the unsecured is likely out of the money. But okay, hey, let's cut the BBBUI at that, unless anyone else wants to talk about it. It's 5:10. We started around 5 after, so we got through all the prepared content. We talked about, just to kind of recap, we talked a little bit about this, quote unquote new bull market, the lack of fear now in the market, with the VIX dropping meaningfully. We talked about Lucid, Lyft, Alibaba, Binance, and Bed Bath Beyond. What else is there? Again, anyone in the audience, if you want to come up, if there's some major stories this week that you'd like to talk about, or some things that are maybe on your radar that you think everybody should be aware of, would love to hear it. Yeah, we can keep going till bottom of the hour or longer if the conversation is there. Otherwise, we'll get people started on an early weekend.
Sorry, I tuned in a little bit late. Did you talk about the big move into money market funds today?
We didn't talk about that. I had included a lot of that stuff in my notes for the week, though. So I have a couple graphics. Let me see if I can put it on the screen. But yeah, right. So the big declines in bank deposits and the big shift into money market funds is worth talking about. I mean, we were clearly going to have a pullback in credit, and that should help the Federal Reserve achieve its goals without it having to raise rates as high as it maybe would have otherwise. And one other graphic I saw this week that I thought was interesting is so it was this one here. Again, if you're following along, it was in the Wall Street Journal. It was basically, it's from FDIC. It's public information, but it was showing the mix of the primary method of bank account access. So like this gets back to we I think talked about it in the kind of when the crisis was going on, that like it's a very different world today than it was even just a few years ago. So the FDIC showed that like the primary method of bank account access, mobile banking in 2017 was less than 20%. It was maybe 1 in 6 consumers, that was their primary method. Fast forward to 2021, and it was nearly 50%. If you're in a mobile banking app, it doesn't take you much more than a few seconds to log into your account and to transfer your money from bank A to bank B. I mean, it is a commoditized business. Obviously, I'm sure people have read kind of the wonderful praise that some of the First Republic customers have said about their bank and yada, 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 which is all well and good. You can love your bank, that's fine. But the switching cost is basically close to zero. I mean, the Silicon Valley Bank situation, the depositors really were breaching their credit agreements by pulling their capital. But when they were in their Slack and telling all of their CEOs and whatever to get their money out, I guess they didn't care about their agreements with the bank, and they did so. But right, that bank saw $42 billion leave in a day. So the whole notion that deposits can be sticky and that it's hard to have a bank run happen overnight, right? Like this is just completely new. We didn't have mobile banking in the 1920s, right? Even in the 2010s, we didn't have mobile banking during the GFC. Nothing like the extent we have today. So the risks of capital leaving demand deposit accounts and savings accounts and the like is real. You can see the other graphic talking about this was an odd lot from earlier this week that they had with a Barclays strategist, where he sees a second wave of outflows coming for banks. Because look, it's one of those things where once you see it, you can't unsee it. Everyone sees now that leaving my deposits, leaving my however many thousands of dollars, even if they're insured, right? Which that's another conversation, at BAC or Chase or Citi or Wells, and earning a basis point or two is kind of silly when the U.S. Treasury, I can buy treasuries for 400 plus basis points more with no risk, and it's the Treasury Direct site sucks, but it's not that difficult for a consumer to shift their capital either to a high yield savings account, right? Digital banking is, again, as I mentioned, very ubiquitous now. So the ease of deposits, moving out, and it's real. And like, who knows what happens now? I mean, I don't know the extent to which it hurts the economy, but it's hard to argue that this isn't going to linger with us for some time. And it seems like even if we've stopped the crisis, which is fantastic, right? I've said this. It was the best of a bunch of bad options that they chose, but they decisively said that uninsured depositors are safe. Now they opened up the can of worms. What does that mean in a non-systemic issue? But when there's a systemic crisis, they can say, listen, relax, chill, which doesn't prevent now depositors from reconsidering leaving their cash, earning a pittance somewhere.
Yeah, I think on that Matt Levine newsletter that came out yesterday, he was also talking about the whole narrow bank situation and the reverse repo, where basically now people are putting their money in money markets, and these money markets are parking it at the Fed to get 4.8%. And it's basically bypassing the entire banking system. And the whole point of a bank, right, is to make loans that are risky, inherently risky, to help the economy, right? Like people need financing for homes, for businesses, and if people are just going to park their money with the Fed, bypassing all of that, what does that mean for the economy?
Yeah, it's a quandary. Your point about money market funds, again, I pulled the image up. I mean, it's like hundreds of billions of dollars have flowed into money market funds in the last month. And why will that stop, right? Like it's depositors are aware of this more now than they would have been had there not been bank failures and an averted crisis. So the problem's not going to go away, right? And then these banks will either, some of them may have to raise capital on unfavorable terms. I think this is the concern I have about regional banks, and why, unless you're a really deft analyst, you should probably steer clear of the sector. Generally speaking, you don't need to be invested in banks. But like a lot of these companies are probably going to have to raise capital, and who knows, there very easily could be more failures. Which again, if you're a depositor and you have insured deposits, you don't need to freak out. You don't need to take your money out and put it under the mattress. I mean, I jokingly put a poll out on my personal account. I think it was yesterday, asking what people were doing for their cash needs. And let me see. So I said, what is your preferred cash-like vehicle today? And I did this on the 29th, and 43% said U.S. Treasury bills, 17% said FDIC-insured bank CDs. 23% of people said the mattress. I hope that they were just being goofy, because it's fun to be a jokester. But FDIC insurance, if you are an insured depositor, you don't need to be freaking out, right? You shouldn't be freaking out and taking your money out and putting it in the walls or digging a hole in your backyard. If you have deposits that are uninsured, though, which again, like, this goes back to the notion that businesses need to have enough cash to manage payroll and whatever other working capital. Like, if they're over that limit, I understand why the SVB situation, had they allowed unsecured depositors to take whatever the haircut would have been, it really could have just been a crisis of confidence that just went through the entire system, caused a lot more damage than it did. So I think they did the right thing, but the genie's out of the bottle now, and these deposits are going to seek higher yields, and it's going to slow down the amount of credit that's being issued and is in the system. And again, it should help the Fed. I think the Fed is done, frankly. I think that there will not be another hike. And I think the market, let me look at what the most recent pricing is from futures. It looks like it's still about a coin flip that they'll stop versus doing another 25. I actually just think given there's a lot of these headwinds for consumer spending, with the student loans coming back on, with Medicaid today being the last day, you're going to have a lot of, I think, folks who are returned to the labor force by virtue of that. So I just got a lightish reading this week. And again, look, all of the data the Fed looks at, they look at trailing data and they look at forward-looking data, right? but the headline number is a very trailing figure. So as long as and the inflation expectations just keep showing that there's not a like major issue here. I know I mentioned it. I think it was in last week's discussion or the prior week. The New York Fed data showing that consumers really, when you look out 1, 3, and 5 years, don't see. They certainly don't see hyperinflation. And now you have from the University of Michigan survey, consumers expect prices will climb at an annual rate of 3.6% over the next year. That was down from 3.8% earlier in the month and 4.1% in February. So you're very rapidly seeing consumer inflation expectations deflating. That's what the Fed wanted, right? The Fed wanted the consumer to, really pull back, to have some demand destruction, to not be, forcing prices to continue going up. The survey showed that they see costs rising 2.9% over the 5 to 10 years. That's pretty much in line with what the Fed is going to want to see, right? Because the way they calculate PCE is a little bit different than how CPI would be calculated. So I just feel like now we have this crisis. We don't know the extent to which, and that's what the chairman said, a week and a half ago, right? He doesn't know. No one knows the extent to which this crisis is going to permeate the entire economy. So it just seems like the prudent thing to me is for them to be done with the hikes. I don't think that it sends any meaningful message they need to send, right? If inflation expectations are going the way they want, the consumer is, running out of gas, many of them. There's going to be incremental headwinds for many coming in the third quarter. So, yeah, again, monetary policy, long lags. You're just shy of 5% for the range midpoint. I think it should be over. And in the market, though, this is the problem, right? The market is pricing these rate cuts. Because the market very rapidly priced these rate cuts, these rate-sensitive industries and sectors saw capital flowing back into them. And one thing doesn't match the other, right? If the Fed is cutting rates because the economy is now facing some other crisis, or this crisis flares back up, or whatever, I just am struggling with reconciling how you see, how the bond market is seeing things, which is kind of screaming, recession coming pretty soon, versus the equity market, as we kind of led off the conversation, where Nasdaq had one of its best quarters on record and is basically back at where it was within 2 or 3% of the Jackson Hole speech that Powell had in August of last year. In my personal account, after 3:30 this afternoon, I began to nibble on some puts on some of the major tech players because it just seems pretty overblown to me. Which, hopefully for those of you who are long tech now, you're going to get a nice melt up on the back of me doing that. I don't know, thoughts, guys? Guys, gals, whomever. So you can go ahead.
Yeah. So, I don't know if you've been following. What was it, like the UK numbers came out last night? Their GDP actually grew, but then their inflation also went up. But what you're saying about what's been happening recently in the Fed, you don't think? Like if they're trying to hit that 2% inflation target, they're probably gonna hold course no matter what happens, right? Or is that what you're saying?
I'm saying I don't believe they need to be hiking incrementally from here. Net of everything, net of all known information, right? That's what Powell's always saying, right? They're going to make the decision based on what they know at that point in time. And it seems clear to me with deposits leaving the banking sector, and there will therefore be less credit activity. There's going to be tightening from this beyond what the Fed would need to do from a Fed funds rate perspective. That they, again, if consumers are seeing their inflation expectations plummeting, we already know, again, with the housing market and the most interest rate sensitive, that space is just slowed down massively. And it does vary, right? There was a good story in Wall Street Journal earlier this week. There was a good graphic that kind of showed city by city. I have it up on my screen. This is from Black Knight Home Price Index, just you can see at least in the tech centers, prices are down, double digits year over year now. Unfortunately for me as a Floridian, everyone's moving here, and our prices continue to rise. But I don't know. I think the inflation story is pretty much in the rear view. And I don't want to say it's in the rear view mirror. I mean, it's a real issue that's still elevated, but the risk of it getting out of control seems like it's the risk to me is skewed now toward the Fed over tightening and inducing a more severe recession than would otherwise be necessary for them to get to their 2% policy goal, which again they don't need to get to it overnight, right? They let me pull up the last summary of economic projections that they updated last week or a week and a half ago. Like they want to get there, but if they get to 2.5, if they get to 3, that, not that they'll say mission accomplished, but that obviously feels a lot better for them than where we sit today. And I think that the trend is going to keep going in that direction. Again, if I know I'm sure some people feel strongly the other way, but
no, I mean like Goldman Sachs projected that there were going to be like pauses and then like a rate cut by like Q4, but then like Powell said himself is like, no, like he straight up said, I don't plan to cut or whatever at that last.
And that's what the dot plot, the Fed dot plot shows, is that the Fed participants basically all, not all, but most have it penciled in that there would be one incremental rate hike. But again, that was at that point in time based on their best guess. That is their median scenario that each member puts down based on the median anticipated outcome. What I'm saying is that I think the impact on the real economy is nothing from this huge outflow of depositors and the likelihood of tightening in credit, which should help the Fed and mean that they don't need Fed funds rates to go up further. The 2024 year end was like 4 in the dot plot. So they have cuts in their dot plot not happening until 2024. The market thinks they're going to cut sooner. The bond market does. So it remains to be seen how that plays out. They do think that PCE inflation by year end will be down to 3.3%, and that by next year PCE will be down to 2.5. Remember, PCE is always a little bit less than core because there's the calculation involves some substitution that doesn't go into the core. Into the CPI. So CPI kind of always comes in higher than PCE, just as it doesn't matter. But they think that they're on the right trajectory, and I think that they're still a little bit overly optimistic with it, right? They still kind of have soft landing and things going really well on their score sheet on their SEPs. I am concerned that when things start to go wrong, it usually goes wrong faster than it goes right. And that clearly seems to be kind of what the market is thinking, is that there's going to be a lot of cuts coming. The Jan 24, what's priced is basically like, I think 3 cuts, two to 3 cuts is what's currently priced by year end or by the end of January. So the Fed's saying no, Powell said no, right? But the market is saying otherwise. And yeah, we'll see how it plays out. But I do think that they're done. There won't be another hike in May, in my opinion, as of now.
Well, I'm hoping that's the case. But then, what was it? The ECB, what's her name? Christine Lagrange or whatever. She was like, "Yeah, we got to get like core inflation back down even more." But I don't know how reflected that is of like the U.S. like monetary policy.
Europe has its own, right? There's a land war going on still, and there's a massive kind of price pressure on energy, which was of course a lot better than it could have been because of the winter not being so rough. So nat gas bulls got slaughtered, but that's a big factor that Europe is kind of facing that the U.S. isn't.
Okay. Like I kind of missed that conversation about like the Chinese markets. Like I got most of it except like my Twitter just kind of like bugged out for a second. Like are any of you guys like moving into like Chinese petroleum by any chance? Like I know like a lot of people are like moving in for like the Chinese like full reopening play like by Q2 or Q3. So maybe like Sino Petroleum or something like that.
I don't know about the petroleum. Some of these state-owned companies, I don't think Americans are allowed to own or trade. So I would definitely look into that if you're concerned. But I'm currently invested in a copper company in China. But other than that, no.
Yeah, in my personal account, I don't have any Chinese exposure. I don't intend to have any Chinese exposure.
I kind of nibbled on a little bit of Baba yesterday. Like I kind of pulled the trigger. Like I saw what's his face, Burry and a couple other people like buying Baba and JD when they released their was it the 13K or like I'm forgetting these the filings numbers, but so I got a little bit into that thinking but the petroleum play I kind of want to like figure out if there's a way to get into. I'll look into it because I think that could be an opportunity, but that's just me. So
Excuse me. What I was buying today in my personal account, though, I bought a lot of British American tobacco, which I feel like a broken record, but it is now down to a 7.3 times forward PE and an 8.1% dividend yield for 2023. So if you have an appetite for nicotine in your portfolio, some of these have just gotten extraordinarily mispriced. I think, again, part of it, I think funds don't want to hold sin stocks at the end of quarter. So I wonder how much we're kind of painting their books not to own sin stocks. And of course, the kind of, I think, as I mentioned earlier, the relative outperformance of growth versus value is as extreme as it's been since the dot-com mania. So value's really taken it on the chin with kind of the flows into growth, which again, can that continue for longer? Absolutely. There's no reason it couldn't, but if you're buying businesses and you're trying to buy future cash flows rather than momentum chase, I think there's some very interesting value companies, and of course, my largest personal holding is BAT or BTI rather, and I actually got my rollover IRA to 100% BTI today. So
I saw that post.
I am just going to be smoking them dividends, baby.
206K is in a meme, baby.
Yeah, Chris, how was your BTI chat the other week? I had to miss it because I was pretty hungover on my birthday. I'm not gonna lie.
Yeah, it was. I hope you enjoyed your birthday. It
Had
was
a blast.
great.
Thank you.
It was a great spaces. A few people came in and chimed in about British American tobacco. Unfortunately, I kind of rushed. A lot of people weren't able to, kind of speak or make it. So I think we're going to do another one in a week or two.
Great.
So I'll let you know, and you can join in. Would love to hear your insight on. I think everybody would like to hear your insight on British American.
Yeah, we talked a little bit about it on the Wednesday open mic, but yeah, I would love to. I mean,
yeah,
I'm actually so I'm not. Again, I'm not really a user of tobacco or nicotine products, but I've been told by some of the other gentlemen that are invested that I need to try to appreciate just how much better BAT's Scandinavian nicotine pouches are than the competitors. So I'm gonna import some Velo, I think, and give it a try.
Oh wow! Be careful with that stuff. I don't do any tobacco or any nicotine. I never have, but I got into tobacco beginning of last year with a Swedish Match. Yeah. And it was actually Wealth or Die talked about it, I think in 2021, and I kind of put it on my radar, and then I bit the bullet, and it turned out pretty good. I kind of wanted to hold it long term, but they had that buyout from Philip Morris.
Right. Yeah. I also, I wish I'd bought more before the Philip Morris buyout, and B, I also would have much preferred to just keep owning it. But one thing that to kind of go a little in the weeds on how that stuff works, and I've understood from investors that spoke to management at Swedish Match like why they were willing to sell. So remember, you've got to have FDA approval in the United States to sell new tobacco and nicotine products. So Zyn, Swedish Match's product, was approved, but like they currently still have like 60+% market share. But the expectation is that in a few years, when the big players are able to bring better products into the market under FDA approval, like Velo is going to, I think, bring the Scandinavian Velo, BAT's brand. And, they sell a US Velo today, which I've been told, again, I have not consumed it personally, but from the sum total of discussion with other investors, seems to be that the Scandinavian product's superior, and that'll be coming in 2027. So I think Swedish Match saw a lot of competition coming and is kind of like going out on top. And they it's still a rich multiple that PM paid. But, for PM, it's great. I mean, I want to get exposure to Philip Morris International again. I'm just a very stubborn when it comes to paying high multiples for businesses, and it probably is justified that it's worth what it's trading at, but I would prefer to buy it in the 80s. Right now, Philip Morris is now at a 13.5 forward EV to EBIT, and when I look at BTI at 7 point whatever, it's like I just think BTI is so much superior at current valuations that I'm putting all of my nicotine capital into BTI. Personally, and eventually I'd love to own some PM, and maybe Altria can stop destroying capital. And even Altria, though, you're probably going to get a solid teens IRR no matter how you slice it. Low if they don't do anything with RRPs, high if maybe they will start winning. But again, as someone who's not a tobacco consumer, I try to like put the cap on when I go into a convenience store or into a place that sells the product. And it's really hard to understate the reality that, at least in the US, Philip Morris has all of the prime real estate. When you're looking, at your Walgreens or at your Circle K or whatever, and you look back there, Marlboro is on the top. All of the MO, the Altria, products get prime real estate, and distribution is so important in this space. So, I would not count Altria out. I just think, again, at the current prices, BTI is just the best of them. But I could certainly be wrong.
Yeah, I think we looked earlier at Turning Point Brands a few months ago.
Yeah,
they have their nicotine pouch. And they're really struggling. It's gotten pretty good reviews online from people that are avid consumers of this stuff. Again, I don't consume it, but you just can't find it anywhere. Like, there's very few shops that can carry it. So,
for Turning Point Brands, they own the rights to distribute Zigzag brand. So Zigzag papers, cones, for both. It's a play on both tobacco, because they also have some smokeless tobacco dip brands that they own. But they also, I think, the TPB, Turning Point Brands, because of kind of getting exposure to the papers and through Zigzag, you also have the longer term cannabis opportunity. And while I don't have any exposure to TPB right now, yes, that is another one that I'm interested in, and for the right price, which is really not far off. It's really just I really want to see how the consumer can keep getting through the next couple quarters here, and maybe we'll get a little bit of a drawdown, an opportunity for better entries.
Yeah, TPB is pretty highly levered given their size.
That's another issue. Yeah, and that remember with BTI was kind of the challenge. They've had to pause their buyback because they are a little less than 3 turns levered. I think it's like 2.9, right? And they're trying to get their range is 2 to 3, so I think they're going to try to get down to like 2.5. And once they get there, I think by the end of this year, they're going to turn the buyback program back on. So, hopefully between now and the end of the year, we get the FDA comes out with a menthol cigarette and cigar flavored cigar ban. The prices all go, really, really low, and maybe we get some generational buying opportunities. Maybe my portfolio would be all tobacco before it's all said and done.
Yeah, speaking of share buybacks, Allison did a good number last quarter. Remember
Yeah.
it dipped below like 33, I think.
Yeah, and then they stopped by November when it shot
Yeah.
up. So I saw that their proxy statement actually, again, like, little ways to kind of get, updated information, right? The quarterly filings are going to provide you with the the shares outstanding on a, 4 times a year. But in this case, the proxy statement came out, and actually share count was up just a little bit, right, from some of the different annual incentive payouts. So clearly they're not buying back shares, or they haven't been buying back shares, it looks like, quarter to date with the share price here. They're pretty conservative operators, so it doesn't surprise me that
Yeah.
they'll let cash build a little bit, de-lever a little bit further. And I know I've said this multiple times. I think the biggest risk to the Allison long-term thesis is actually them getting taken private before you're able to realize the valuation disconnect. They're trading at basically the same forward EV to EBIT as British American Tobacco, 7.8 for Allison Transmission Holdings.
Oh, nice.
Which, if you look back over the history of the company being public, there've only been a few months where, really only a handful of months in the last year or so that it's been cheaper on a forward earnings basis. That company, unfortunately, has just borne extraordinary multiple compression under EV fears, which some are valid, but I think are overly priced in. And that's why Allison is my second largest position in my personal account. But anyone else want to chime in? It's 5:42. We've covered a bunch of stuff. I'm gonna call it at the top of the hour, so I can start my weekend, and then folks can be on their way. So if anyone else still wants to come up as a speaker and ask any questions, chime in on any of the topics we covered, or otherwise, please feel free to. Joe, I know we're still like edging ever closer to our social media. I don't know if the word enhancements is right or not, but I wish I could share more with the audience today, but we're just slowly but surely getting close to sharing some exciting stuff, I hope, with people.
Yeah, we'll share more soon for sure.
And not to be cryptic. What else?
Did you guys already cover the energy market, or did I miss that portion earlier?
No, we didn't really talk about the energy market yet. What aspect of the energy market were you wanting to talk about?
Like for the next few quarters, like what your thoughts are, and I know like you bought those calls for like VTNR.
So yes, I had bought VTNR calls. So in the GME chat, I shared that I decided to fully exit those. I realized 110% on those, which was a nice gain in a few weeks' time. So I fully exited the July calls just because I wasn't happy with how weakly it was trading in the market. And I figure, let me lock in some profit. I still have like almost a 400 or so basis point exposure to VTNR. The mechanical completion of their hydrocracker conversion to allow them to produce renewable diesel was supposed to be by the end of the first quarter. So the fact that we don't have a filing yet, I don't know if they're going to wait to do like a multiple kind of updates in one or what. I saw on StockTwits a guy who lives in Mobile, Alabama, who has gone and driven around, by the site and shared due diligence before. He had shared an update that he was there. I think this was yesterday. He shared it that he was there. They still have a lot of buses bringing people into the facility. So I don't know, if it's going to be delayed by a few days versus meeting that target, a week. I'm not worried about the investment per se, but it's a very volatile stock, and I rang the register on on my 80 July $10 calls that I had gotten for 67 cents on average, and I was able to exit those at a $1.40, one or two. But like the energy space broadly, I mean, the data continue to show that inventory levels are relatively light, and we're still seeing draws on inventories. So when I think about like refiners in particular, I still, have between VTNR and PBF, I have a pretty large U.S. refiner exposure because I think that it's going to stay hot, and the crack spreads are still hot. The inventories are still light. They're still, not. I mean, the PBF, their March deck kind of put it most clearly. Capacity is down meaningfully from 2019 levels. Meanwhile, demand is above 2019 levels, plain and simple. And it's a tight market. It's going to stay tight. Eventually, incremental capacity comes online in later this year and next year internationally. And I'm sure that the crack spreads are going to come down. But in the meantime, it's just, these refiners are trading like at less than 3 times EV to EBIT. So they're just stupid cheap. Granted, are they cheap on multiples that are peak multiples? I don't know if they're in trouble on that regard, but yeah, we'll see what plays out with the refiners. I'm still pretty bullish on them, and I'm also pretty bullish on the Latin American integrated majors, thinking that the risk is overly priced into, say, Ecopetrol and Petrobras. And I know that for Petrobras, there was like a rumor that came out. It was a rumor. It was like they leaked a graphic that the dividend was going to be continued. So I don't know. The stock is still trading, badly, whatever that's worth. It's unloved. Which again, how much of the political risk is priced in or under or overpriced? That's a valid question to raise. But I saw Lanita came up. Ionita. If you wanted to chime in.
Hi guys, what are you talking about?
We were talking about oil refiners, talking about financial markets. Yeah, sick. I was. I said on Wednesday that I actually had gotten my energy exposure to be larger than my nicotine exposure in my personal account, which I didn't really like. But again, that kind of highlights how bullish I am on energy, some parts of energy right now.
Yeah, actually, the other thing that I want to ask you was, I know like we're not refilling our strategic reserves yet. Also, isn't that? Do you think that the market's already priced that in, or people are just still trying to figure out when that's going to happen, and the market's still trying to price that in?
Well, right, there was news last week from the energy secretary that the quote, this year it will be difficult for us to take advantage of this low price. And this was what she reported to Congress. So presumably she's not lying to Congress. Quote, but we will continue to look for that low price into the future because we intend to save the taxpayer dollars. So they had said, right, that they want to buy around 70, and the price had actually gotten around that point, and they're not able to buy in part because there's some maintenance being done on some of the salt cave facilities in the Gulf Coast. So basically, that maintenance is going to make it difficult for them to buy back oil this year, even though the price is at the level they want to buy it back. So presumably, you do have a bid in the form of the U.S. government that will appear at some point if it's at or below these levels. It would be regrettable if we get through year end, the U.S. government's been unable to take advantage of what I think will be And while over, say, like if you look back a decade, 60, ish is like, yeah, okay, that's kind of what the price has been. But in the context of clearly some inflation and also, um, really minimal like investment in production and exploration, I have to think that 60 edges up into the future, because oil is going to be with us for many decades to come, whether you want to be upset about it or not. That is reality. So yeah.
Actually, that also brings me to, I guess, like my final question about energy. For those strategic reserves, is there a specific company like that they have to buy from, like whether they have to be U.S. or are they allowed to buy from any source worldwide? Is there like a federal mandate for that demand? Like I'm not 100% familiar with like the energy market, so
Yeah, I don't know if anyone does know. I mean, I would assume they're just going to buy oil off largely just the spot market, and they're not going to they're not going to buy Russian oil. I assume they're going to buy American oil.
All right, thanks for that info.
Absolutely. All right. Well, seeing no other hands then kind of coming up from the audience, I'm going to wind it down and thank everybody who opted to tune in and join the conversation today. It was a good one. Touched on a whole bunch of things. The replay will be available on the Wook Capital YouTube. If you kind of tuned in late and want to catch up maybe with the part that you missed, Joe will get it uploaded onto there shortly. I'm going to send him the file once we get done so he can work on that. As I mentioned, if you look in the pins, we do have the book list for the balance of year. So for April, we're going to be doing Michael Lewis's The Big Short. So if you want to just watch the movie, you can. I'm excited to read the book because I never have. I think it's a very timely conversation to talk about kind of how those various different individuals and entities traded successfully against the housing bubble and monetized, what became the Great Financial Crisis. But even though I don't think are in a financial crisis or facing that, I do think that for now that's been effectively diffused by both the U.S. and Swiss and European regs. As we talked about, though, there's definitely some challenges to come from reductions in lending throughout the economy, with these deposits flying out the door, and it remains to be seen where we settle. So hopefully, though, it was an informative and interesting and enlightening somewhat discussion today. And we'll be back next Friday, as we always are, with our Wook and Review at the close. And then if you want to tune in Wednesday night at 7 Eastern, we'll be back with our market open mic. So thanks, everybody, for your interest in Wook Capital Management. Be sure to follow at Wook Capital and subscribe to receive the newsletter in the mornings or on the Friday morning. And check out both the Wook Discord, and if you'd like to join the GME DD Discord as well. We're always having good conversations in there. So hope to talk to you all soon. Have a great weekend. Cheers, everybody.